So we are now halfway through July. We've had some really big ticket items come through in the news in the last few weeks. Labour won the general election, so we have new leaders of the country. After 14 years of a Conservative government, we're now going to see what it's like to have a Labour government. So we're going to see how that has affected my portfolio and how it could affect our portfolios in the future. We've also seen that McDonald's have been struggling over the last 6 months or so. They've been losing the general consumer over the last 6 months. They're having to up their prices all the time. So we're going to see what they've been up to see what they've been doing to combat losing all of their customers, and to see if what's been affecting McDonald's is going to be affecting any of the companies that I own, or to see if it's been affecting any of the other companies in the same sector. And we've also seen that Nvidia has been flat over the last month. So we're going to see why they've been flat, what that means for the rest of the economy, and what that means for the stock market. Let's get into the video. So first, let's just take a look at the performance of the portfolio in the last week to 2 weeks. So you can see here, my portfolio in the last month is actually up £328. This is just my portfolio on free trade. I do have a portfolio also on Trading 212. I'll show you that after this. And over the last week, it's been up £17, so pretty much flat. But you can see the performance has been really good over the last month or so. This doesn't include any additions to the portfolio. I haven't added anything to this portfolio. I've just been receiving dividends, using that cash to buy more positions. One of the main reasons why my portfolio has done really well, actually, is realty income. So realty income is actually up 5% this month, and it's one of my bigger positions. It's good to see this, actually, because I've been going on about realty income going up in price a lot, and they've been flat over the last, well, they've not been doing very well over the last 6 months. And you can see there the big spike, where finally I think they're going to see a bit of relief because interest rates will begin to come down very soon. The other really good performing stock at the moment is Lloyd's. They've had a really good couple weeks. Since about the start of the month, they've had a massive rocket up in the last month or so, and they're up about 9% just in 1 month. Other than that, I haven't seen any other really crazy moves. So let's go and take a look at Trading 212. So my portfolio is actually sitting at about £3,000. I have about £1,600 in cash sitting in the account, which is just getting 5.2%, but that'll be deployed when I see fit. You see, I don't have many positions in this portfolio, but eventually my free trade portfolio will move over to Trading 212. The only one really of note in this portfolio right now is Visa, and realistically, over the last month or so, they haven't done particularly well, and I think this is to do with consumers running out of money. There's a lot of speculation in the market right now to do with these types of companies, because consumers are running out of cash, they're going to debt, and then they're running out of the ability to pay for their debt. That means there's going to be a lot of defaults, and there's going to be a lot of money sitting around almost lost. Companies like Visa will deal with a bit of this. People won't be spending as much. The markets aren't seeing Visa as the best company right now. So now let's talk about the main thing that this video is about. We have a new government. Labour have won the election after 14 years of a Conservative government. We now have a Labour government. Now, we don't really know what's going to be happening. There's a lot of speculation based on what happened last time when Labour in power. But I think this time, Labour are more of a centrist, more swinging towards a Tory party than the Tories are, really. There's been a lot of speculation about what they're actually going to be doing. And I think in this video, we're just going to have a quick glide through some of their big policies, some of their outline policies, and then we'll discuss how this is going to affect our portfolios. One of the first things that I noticed was that they want to set up Great British Energy. Now, we don't really know what this is going to be about, but this could affect any energy companies that are in the UK, based in the UK, that serve the UK population. So companies like Octopus, companies like OVO, companies like SSE, although I think they've now been acquired by OVO, haven't they? Companies like British Gas. These companies could actually be affected by this new thing that Labour are bringing in. So if Labour bring in a publicly owned energy company and they're serving the public with energy, this could mean that money is being pulled out of companies like British Gas, SSE, OVO, Octopus, which means it could affect their stock price. So this is something to think about. When we find out more details about what's happening with Great British Energy, then you have to sort of make that decision and go, actually, is this going to affect any of the companies that I own in the energy sector? One of the bigger ones that I've noticed is they want to build 1.5 million new homes. This is interesting because, well, this will probably be subsidizing house building companies or giving money to house building companies to push the house building along. So if you own any companies in that sector, house building companies like Persimmon, Taylor Wimpey, Barratt Developments, Bellway, then you might actually see a little bit of gains over the next few years, in addition to the already gains that we probably should expect when interest rates are going to come down, because houses will be more likely to be built and sold over the next few years if interest rates do begin to come down. So that is one of the main things that I've seen. So they're saying they want economic growth across the country, but it is hard to quantify a lot of these things. Labour's 5 key missions that are set out for their new government is going to be reviving economic growth, very broad, making Britain a clean energy superpower, which again is very broad. This is to do with their energy, Great British Energy, reducing crime. I don't think that's going to affect the stock market as much. Reforming childcare and education systems. Again, that's more of a social thing. It's not to do with the stock market. And building an NHS fit for the future. Again, we don't have healthcare stocks like they do in the US, and the NHS is private, so we won't be seeing any stock market gains from that. But generally, if he can hit on all the points that he said, and the country economically is fine, so we can afford all of the things that he wants to do, then I think this could be good for the stock market. We could see some actual economic growth, potentially some better growth than we've seen over the last 14 years. I don't think I'm too optimistic. I don't think I'm too pessimistic. I just think that we'll wait to see what happens, wait to see anything else that comes out. It's only early days, so we'll see what happens. Anyway, McDonald's stock price is down 15% this year, which is quite ridiculous considering that over the last 5 years, McDonald's has been quite good. You know, they're a steady grower. They pay a good dividend, high dividend growth every single year. But they've been struggling, and I think this is due to inflation. They've struggled to keep their prices down, and pretty much every single quarter over the last year or so, they've had to up their prices. And you can see there's been a few spikes in the stock price, and that is due to mildly better performance. So McDonald's has really been living off of upping their prices every single quarter. We can see that here, that between March and June 2023, they had a massive increase, which is a price increase that they did, a massive increase in revenue, which is a price increase that they did. And then the next quarter, again, prices increased, their revenue went up. But we can see here, prices are still going up, but their revenue's gone down. And again, in this quarter here, their prices have been going up, but their revenue has come down. That is now reflected in the stock price. Year to date, since the start of the year, they're down 15%. In the last year, they're down 14%. So that's been reflecting in their stock price over the last year or so. So in the UK, in May and June, they were actually offering a £3 mix and match meal deal, which I think they were offering like McNuggets and McFlurries and burgers for £3. And you get 3 things for £3, working out £1 each item. But they were obviously losing money on this. And in the US, they announced that in June, they were doing a $5 value meal, which includes 4 items. You get like a McChicken or a McDouble, 4-piece chicken nuggets, fries, and a drink, all for $5, which, again, that's very, very cheap for what McDonald's actually is. So they're losing money on these items. But they're doing this to get customers back into the restaurant and trying to win them back over. But I don't think this is going to last. The prices need to stop going up. The prices realistically need to come down, but that isn't really going to happen. We just need the economy to sort of get a bit better. People need to earn more money, and then they'll start going back to McDonald's. We know that the McDonald's stock price has been affected by this, but how's this affecting any of the companies that I own, or how is this going to affect any of the other companies similar to this in the same sector? So one of the stocks that I own that could be affected by consumers pulling back on buying these sort of staple items in their regular lives is Pepsi. So I have about £1,000 invested in Pepsi, and it's currently down 7%. So if we take a look over the last 1 month, it's up 3%. Over the last 3 months, it's about flat, about down 0.3%. In the last 6 months, it's also flat. But over the last year, it's down 11.6%. So Pepsi has been hit by some of these cost pressures over the past year or so. We have seen recently in the news that Dr. Pepper overtook Pepsi as the US's second most favorite drink after Coca-Cola, which does say something about Pepsi. Maybe their prices have been going up more than the other drinks. The other things that are similar to McDonald's in a way is a consumer defensive stock like Tesco. Tesco has been sort of the opposite of these other consumer goods are doing. In Tesco have actually done quite well recently. So over the last month is up 4%. Over the last 3 months, up 10%. And over the last 6 months, which is year to date, is up 4.7%. And even in the last year, it's up 26%. So Tesco is actually doing really, really well in face of consumers sort of having to pick the best option for their money for these staple items in their diet. And Tesco obviously is a supermarket. They're the biggest supermarket in the UK. They have a big market share, and clearly they've been doing very well in keeping their customers happy and actually keeping their customers coming to the store, even potentially taking more market share than the other supermarkets. So we can see that some stocks like McDonald's, like Pepsi, are being affected. And if we take a look at some other stocks that I don't own, so for example, if we have a look at Nike, that's another consumer staple item where consumers are choosing Nike to buy their trainers, for example, but instead they're actually not going to Nike anymore. They're going to other places. They might be going to a supermarket to buy their trainers. They might be going to a cheaper shopping place. Maybe they're going on ASOS. Maybe they're going on, some of these Chinese retailers on Amazon, maybe to buy trainers or their sports gear. And that's where Nike has sort of been affected, where they're having to raise their prices, whereas these other providers, like a supermarket, like Tesco, or like Amazon, or like ASOS, potentially they're being able to reduce their prices. Maybe they're not raising their prices as much as Nike is having to do. As Nike is probably trying to keep their gross margins high or their net margins high, these other places like a supermarket can bring down the cost of their foods comparable to McDonald's, or their clothing comparable to Nike. And therefore, these companies that have these big brands, they're actually struggling because they're used to having such high margins because of the brand value. But because of the weak consumer at the moment, brand value is sort of being thrown out the window for affordability. Now onto the last news item that I want to bring up in this episode is Nvidia. Nvidia has been on an absolute rampage over the last year, year to date, 1 year, 5 years. Their performance has been absolutely ridiculous. But when we look at it, they're at all-time highs. They were at all-time highs in middle of June. And since that date, they're actually down about 4.5% since they hit that all-time high in the middle of June. And if we look over the last month, they've actually been flat. So what does that tell us about the markets at the moment? Does that mean we've actually hit the peak of the market? Do we feel like we're actually at the peak? Are we going to start seeing a bit of a drop-off from big companies like Nvidia, or even Microsoft, Amazon, Google, the likes of those? If we just take a look and go have a look at, for example, Microsoft. So even Microsoft in the last month, it's up 2.75%. That hasn't slowed down as much as Nvidia has. If we go and have a look at, say, Apple, which is one of the other big companies, in the last month, they're up 7.6%. So when we're talking about Nvidia and them being flat over the last month, I think in reality, it's just a bit of pullback because they've been hitting such massive highs. When we have a look at the PE ratio of Nvidia, it's at 75.6. The PE ratio is the price to earnings ratio. It's the price, which is the $129, divided by their earnings per share. So how much money they're actually making divided by the number of shares that are outstanding. Now that rating of 75 is quite high. When we look at the S&P 500 PE ratio, it's sitting at about 27.45. And that's high in itself. 27 is a high PE ratio for the S&P 500 index. But when we look at Nvidia, it's at 75. We're almost 3 times as high than the market average at the moment. And when we look at even the S&P 500, they're up from 25 last quarter and up from 23.5 a year ago. And even when we compare the PE ratio to Microsoft, for example, which is one of the other bigger companies, their PE ratio is about 39 to 40. So Nvidia is very, very overvalued for what they're earning. And I think there's a little bit of that in the market where people are a bit worried about how high the price is and how far it's going to go. From my perspective and in my opinion, I think Nvidia will continue going. I think they have a bit more to go up until the end of the year. I think we're going to get at least one more good quarter out of them. Their next earnings are due on the 28th of August. So I think we should see good earnings at the end of August from Nvidia, which means that the stock will continue rallying. And I think you'll see a rally up until a few days before, and then you'll see a big dip a few days, like literally right before the earnings date. And then straight after the earnings date, I think there's going to be a big spike, probably something around 10 to 15%. I do think that the rally from Nvidia will end at some point, probably towards the end of 2024, simply because I think that the GPUs and the data centers that Nvidia are supplying for will actually become oversaturated. These companies that are spending billions of pounds on new data centers, new GPUs, huge amounts of money spent on this rush for AI. I think that Nvidia will hit a point. These companies will stop expanding their businesses and they'll start to realize that they've either overspent or that they'll have to wait a little bit of time before they can continue spending money. Because I think that we won't see as much revenue from these data centers that are supplying for like AI, for example. I don't think we'll see as much revenue as they're expecting to be making, at least until like the end of 2025, 2026. until all these products that are being made from AI actually start making money. Because at the moment, there's not really a great deal of money that's coming from AI, is there really? When you think it's like maybe a bit of search, there's ChatGPT when you're people buying a subscription. There's not a great deal of money that's coming into it. I think ChatGPT made like $2 billion or something in the last year. Not a great deal of money when they're spending billions and billions and billions on these data centers from Nvidia. Should we buy Nvidia at these prices? Who knows? In 5 years' time, Nvidia will probably be worth more than it is today. But will it be worth more than it is today in a year's time? I don't think it will be. I think there'll be a bit of a correction. It'll probably be flat for a little bit of time. And I think that their earnings can keep going, but I think the price has gone up far faster than their revenue can keep up with. So at some point, they will post revenue, they'll post earnings, that maybe in August, maybe a quarter later than that, which will be not as high growth as the market is expecting. It will still be growing, I would imagine. It just won't be as high growth as what the market is expecting, and then the market will take a bit of a hit. So that is all for this episode. Thank you for watching. If you liked the video, give it a thumbs up. Any suggestions on improvements to the video content or ideas for content going forward, then please leave a comment below and I'll give you a reply. Come on, England! If you can, just comment your favourite chocolate bar down below in the description. Thank you very much.